Managing the covered call strategy. As with every strategy, there's two steps to managing a trade. The first step is to manage the trade before you've even placed it, and the second step is to manage the trade after you've placed it. So we're going to talk about, just for now, how we would go about managing the trade before we've even placed it, and that involves two elements. What strike price should we pick for selling the call option at, and what time frame should we use? The strike price you pick is very simple. It's the target sell price for the stock. It's the price that you are willing to sell your shares at anyway. That's the price that you pick for the strike price for the covered call strategy. So remember, when you sell a call option against your stock position, you're obligating yourself to sell your shares at that price to the person who bought the call option from you. So if you decide to sell it at a specific strike price, you need to be certain that you're happy to sell your shares at that price. The second part is the time frame, and that's pretty simple. Just go out about a month or two in terms of a time to expiration for the call option. Now that we know what we've got to do to manage a trade before we've done it, let's imagine we've placed the trade and now the trade is on. Let's look at the different scenarios that could play out. So what happens if the share price goes over your target price? So now we've got to expiry Friday. The share price is trading over the strike price of your short call. What will happen? Well, if you do nothing, the shares will automatically be assigned to the call purchaser after expiry. So you're going to lose your shares. You will have kept the premium and you will have sold your shares at the strike price that you picked. If, however, you've changed your mind and you don't want to sell your shares anymore, you can close down the call option, most likely at a loss in that situation, but the loss will be more than offset by the gain in the stock price. So that's a decision for you to make. Our advice would be always stick to your target prices. You've made your target price in a non-emotional environment, which is a lot better in terms of decision making. So we would say stick to your original plan. What happens though if the share price stays below the strike price? Well, you have to do nothing in that scenario as well. What will happen is the call options will expire worthless and disappear. You still keep the premium that you receive for selling the call option. And then what you would do is repeat the process again for the following month. So you would sell another covered call. And that's very simply how you would manage a covered call.